Okay, hello. This is our 7th installment in our series of Zoominars where Cornerstone Legal Services provides legal and financial tools to physicians. It's our way of making legal and financial tools understandable and accessible to all of you. We have brought in experts in many areas of finance, including tax law, business succession, estate planning, and more, to allow you an opportunity to learn from and ask questions from people who have extensive knowledge in areas important to you. So today the past couple of weeks, we've been covering insurance and tax benefits. And today we have Mr. Salim Nathani, who is the founder and managing principal of Benzer Capital based in Texas, a recognized leader in wealth management, assisting high net worth families and institutions, preserving wealth for generations. Mr. Nathani is a managing partner of Benzer Tax and Business Advisors, a tax advisory firm, and Nishana Holdings, a private investment fund. And today he will be discussing managing portfolio, tax loss harvesting, real estate and estate tax savings on properties, and capturing temporary devaluation of your practice. And first we'll start with some background on Mr. Nathani. Thank you for being here.
Thank you, Safura and Honey. Yeah, this is a wonderful pleasure to be on board. Really appreciate it. And, really a fan of the work that you guys have been doing. It's been incredible to see the experts that you've been able to accumulate and really serve the physician population that you have, and really work through to make sure that they're getting the best in class advice and best in class education. So thank you for inviting me. I'm really honored to be part of this today.
That's exactly why we brought you.
Well, thank you. So Safura, you asked for my background. I really, just born and raised in India. I came to the United States, did my undergrad in finance at Oklahoma Baptist University, my grad work at University of Houston, right here in Houston, Texas. And I did my CFP. I'm a certified financial planner with Rice University here in town as well. As you mentioned, Benzer Capital is a firm where our sole purpose is preserving capital, preserving wealth for generations to come. And really that stems from my family's personal experience. And so the reason why we do what we do is very simple. The story really involves my grandfather, who was one of the largest manufacturer of Bunsen burners. I don't even know if you know what that is, but Bunsen burners were the mechanism by which people used to cook and do everything in daily activity. And my family was the largest manufacturer of those in South India and one of the most wealthiest families there. My dad was 21 years old, graduating, almost working through graduating college. And my grandfather went to visit Bombay, for those of you who know India. And he never left Bombay. He had a massive heart attack in a meeting. And my dad inherited a very diverse and large business at a very young age. Obviously, he was unprepared to face the challenges of that. And within 5 years, when he landed in Bombay himself, as he immigrated Northwest India, he had 300 rupees or equivalent of a few dollars to his name. But he had education, he had the ethic of hard work, and he had faith. And he put all of those three to work and built a life, emigrated to the US, and we were raised within those same ethics. So when I joined this industry, I made a promise to myself that I will make sure that we don't have another family that has that experience. That's what motivates us. That's what motivates Benzer Capital. That's what motivates me every day when I wake up. I think about my clients and how we can make their wealth be preserved through generations. So I hope that's a background that works.
That's amazing. We need people like this that are dedicated in these ways. And we're looking forward to hearing what you have to help us learn today.
This is so personal, Salim. I mean, this is amazing. Once it's a personal experience that you had, it just, puts everything in perspective. I mean, this is similar to what Sfor and I, we do. I mean, both of our spouses are physicians, and we see how hard they work and focus on earning a living. And you know what? It's as equally as important is to make sure that you protect these assets. And that's why we kind of, the concept of starting the physicians webinar series just basically arose from this passion. So it's very personal to us as well. So.
Yeah, no, and I think the corollaries and cooperation between our two firms is just a testament of how we can help, preserve what all the physicians have really worked hard to build. And in my experience, our clients and client families typically look for, 3 or 4 things, right? They want to make sure that they're growing their wealth. They want to make sure that they pay their fair share of taxes, not more, right? Mm-hmm. They want to make sure that they are able to pass this wealth to the next generation. They want to make sure that, this particular wealth is not taken away unjustly from them through, any action or legal maneuvers, if you would, right? And finally, for those who would want to and are inclined to do so, they want to maximize their charitable giving. They're giving back to the society and community. And so that's what we work towards. And today we're going to discuss the tax planning piece, making sure that they're paying their fair share, not more than the taxes that is owed. And we'll focus on a particular opportunity that COVID has presented and things that we've seen and we've recommended and advised our clients on that might be helpful to the audience here today.
That's great. Looking forward to, to begin this. Sure you have a lot of recommendations, especially in this, during COVID.
Yeah, it's incredible, honey. I see, and this is not my first rodeo. I've been doing this since 2000, so I've seen a handful, few downturns, and in each downturn, although it is a lot of stress, there's a lot of anxiety, losses, but there are also times of opportunities. And for those who plan, right, they look at these events as opportunities. But opportunities don't come in the same way. They come in different way. As you can tell, like much of the population was thinking, okay, COVID, downturn, there's going to be a lot of real estate stuff that's going to come along, just like it did in 2008, 2009. Well, that never happened. We haven't had, much of any activity in either residential or commercial real estate. In fact, if anything, those prices have actually starting to climb back up, and the houses are in high demand. But a lot of opportunities have been presented on the tax side of the equation, right? And what happens is most people they're so constricted, or they look for the same repeated patterns, they forget sort of what are the real opportunities. And so I'd like to share with your audience a few things that I think they should consider that might be applicable to them, and we can kind of move forward from there and take questions and perhaps provide additional guidance as needed. Gabe, next slide, please. There you go. So we talked about venture capital, what we do, what areas that we focus. One of the things that I do want to add is what we have done is we have created proprietary, trademark, and innovative process that are simple when it comes to our clients, for them to understand, for them to execute, but extremely sophisticated in the background in terms of what we deploy and our algorithms that we work with. And that they find is really a remarkable difference between what we do versus what they do. It's a lot of thought process and putting together an expert team such as your firm to be able to do what we do. So as we focus on taxes, understand that what we're presenting to you may sound simple, but there are a lot of very innovative and things that we can do that you don't see in the ordinary, or can be missed by most lay individuals or professionals. Next slide, Greg. So before I go any further, I also want to kind of share some disclosures and compliance standpoint. I want to make sure that everybody understands that these are, what we're going to be talking about here are general guidelines and thoughts. They're not specific tax advice, so please don't take that and go do it tomorrow. Be sure to consult with your tax advisors. Be sure to consult with Cornerstone, with Sephora, with Hani, to make sure that these are implemented correctly. And they're also not meant to avoid any taxes. They're meant to make sure that you are provided with proper guidelines, and always refer to your tax advisor for any specifics. Okay. Generally, I get asked these questions, right? Are we going to have a recession? I mean, we just had some people call it a V, or some people call it a K type of an economy. And the second question that gets asked is, what are the current tax changes? Are they to our advantage and not to our advantage? And what we find is that the last tax law passed in 2008, implemented in 2009, was such a massive behemoth of a tax law, and it got passed so quickly that most people didn't, kind of understand what was going on. It took IRS and professionals a long time to figure that out. So these changes are in place, and they're not being taken advantage of. And then also the CARES Act passed during COVID also had a lot of tax-related implementation issues that can be taken advantage of. So what changes are there that might benefit you? how do I save more taxes? Right? It's a great question that I always get. What do I do specifically that will help me with that? And final question, as an advisor, I always get is, should I still be investing? For those of you who saw where the market started this morning, that's got to be on your mind. And we're far from the 5% and 7% drop in a single day during COVID times, but still 2% and 3% are not uncommon anymore. So what should you be doing? Okay. So what we'll do is, I'm not a big fan of long PowerPoints. What I've done is I've summarized key findings in a few slides, and we'll kind of explain and share things with you as we go forward. So I'm going to talk about general tax planning, and then we'll move specifically into COVID-related tax planning, if that's okay, Hani.
Absolutely.
Okay, next slide. So the first thing that we need to sort of think about is what I call an investment pyramid, right? Whenever we think about taxes and investment, they go hand in hand. General theme to remember: do not invest for the sole purpose of taxes. Okay, you will always be led astray if you do that, because I've seen some very interesting and not very savvy things done that usually come back to harm the investor themselves, that are claimed to have some tax provisions that are favorable. Always make investment based on the merit of the investment first. And if it comes with tax savings or tax benefit, so be it. But always make sure you make that call based on the investment itself. And so what we do is we start and build your investment profile and investment portfolio in tiers, right? You want to make sure that these are allocations that you can sustain over a period of time. And so you focus on short-term preservation first, having adequate cash reserve. It's the simplest thing that one can know and understand and execute. Sometimes it is the hardest thing for most people to do, because they are either asset heavy, cash poor, or don't like to carry too much cash, or they have expenses and income depreciation difference that does not help them create some short-term preservation. So we want to make sure that you focus cash, short-term debt, high-grade income-focused investments, not only for yourself and your families individually, but if you have a practice, make sure your practice is able to sustain. We thought that medical practices were immune to downturns, and what we found very quickly is that the downturn because of COVID was an equal opportunity downturn, even particularly in hitting heavily a lot of medical practices, primary care practices were hit a lot. And so having that preservation actually helped, the cash on hand helped through that process. Then you would move forward to go ahead and keep and diversify the assets from an estate planning standpoint, from an estate preservation standpoint, and achieve your goal. And so you could look at debt, and of course, we can look at those particular investments that are in Islamic and Sharia-based investments, across the globe. And so you are also taking care of the faith side of the equation, U.S. equity, global equity, industry diversification, or geographic diversification. So make sure that you have a proper asset allocation. We at Benzer actually have a process we call our Benzfolio process that we work with. And then you scale into the next one, where you take one practice and scale it into multiple practice partnerships, or invest in private funds, real estate, private equity investor funds. So then you look at growth only. So take care of your short-term cash, preserve your capital, and then move on to growth. That should be a general principle. And then you can specifically make those for your family. Gabe, next slide. There you go. Thank you. So in order to create a tax strategy, and as I mentioned, I'm going to start with general tax strategy and then move into specific tax strategy. We look at, again, 3 tiers of tax strategies, if you would, right? First is forms of foundation, and what you can do within cash reserves. Of course, we mentioned that that's something that you must take care of, or mobility and business startup fund. If you have one coming up, or you're starting a practice, you want to make sure you put that away. General recommendation there is 6 months for personal side and 18 months, up to 18 months for a startup fund, and depending upon the type of the company. When the first, in terms of the formation of a practice, there are a couple of very interesting things that you can do to make sure that you're taking advantage of the taxes there. How you fund the practice, if you're thinking about starting one, matters, whether you're providing equity capital or a loan to the company. So you should definitely think about what makeup makes sense. And then also, of course, within that context, you should think about what different entity types make sense for you, whether you should be a pass-through entity, S Corp, or a professional corporation. And again, they are different implications depending upon which one you pick, but they're important for you to understand, particularly in the light of the new tax law, where there are benefits for the C Corp versus the S Corp. So here's something that most individuals and even professionals have kind of missed the mark with how quickly the 2008 law got passed. The provisions, the corporate provisions within that law are deemed to be permanent. So at least even when they, and we'll talk about that more if we have some time later on, but even after this election and beyond, anything that has to do with corporations is set in stone unless Congress and the president, whoever that is at that point in time, decides to change that. However, the personal provisions, including the business deductions that were small business deductions that were negotiated, and the lower tax rates that were negotiated as part of passing that tax law, are actually temporary, and they expire in 2025. And most people kind of not know that because it's still out there. But that means you have 5 years to do really good planning if that happens. Now, there's also this notion of what happens next in January, and we'll talk about that. But at least on paper, we have that kind of time to think about it. So one of the first things that we take a look at is what we call a triple tax-free strategy. There are a couple of accounts that actually offer that. Triple tax means it's not subject to federal taxes, state taxes, or FICA taxes, which are your employment taxes. And then we have your traditional and mega pre-tax strategies, and these are mostly retirement plan driven. So you have your individual IRAs, your 401ks, your Sept, Simple. There are opportunities here where we have been able to, particularly for an individual doctor that works in medical hospitals as a consulting doctor, right? And they have their own single member LLC or single member S Corp. We could save somewhere between $100,000 and $120,000 in taxes every year, depending upon the amount of income that they're making. And that's what we mean by mega pre-tax saving strategies. And then you have, of course, your post-tax strategies, such as your Roth, your 401ks, or for a lot of physicians on this call, they are probably not residents anymore. And if you're not, you're making more than any Roth allowance that's out there. How do we fund those post-tax lifetime beneficial IRAs through backdoor strategies, right? And then there are other investment-based, non-qualified strategies that we can implement, particularly depending upon the nature of your practice, who's in there, whether or not we can set up a deferred compensation plans or something else along that line. So that forms your things that you can do on a personal basis, and then you move over to the estate side, and that is charitable and planned giving. How do we create opportunities where you can actually use the estates to help you plan your taxes through family and entity trusts? And I believe you have had several conversations around that, in which you will. That's your specialty. Go ahead.
And we've discussed this in previous webinars. We had our CPA tax senior CPA tax lawyers breaking down basically some of the structures, the vehicles that we have been using for on the estate planning side of things.
Yeah. And so the reason why I went through this sort of overall, and I know it's a lot packed into one slide, and that's why I said I don't like too many slides, because it's important to understand one of them, because we're going to take 1, 2, or 3 of these and see how COVID can amplify these strategies, if you would, right? And trust is a big part of that, and definitely there's a conversation that needs to be had for multiple reasons, and we'll kind of share that here. Okay, can we go to the next slide? So 3 specific things that we feel that we should take a look at. And I'll talk about first is the portfolio's tax loss harvesting. Tax loss harvesting, simply explained, is a strategy where you take a look at your portfolio and you take a look at those particular investments or investment vehicles within your portfolio that are incurring a temporary loss. And basically you sell those positions in order to recognize that loss for that particular year. Depending upon how you do that, it can provide with a large value. Then the question comes in, well, I don't want to sell that position just to take a loss. And the idea there is that you replace that position with something that's similar, but not exactly like that particular position. So allow me to explain. Okay. Gabe, can I share my screen and do a quick write-up? Thank you. So that was our testing there. There we go. So when we're thinking about tax loss harvesting, it's very, very simple. And this became extremely clear, and we were able to take advantage of that, especially during the depths of COVID. And this may be true for many of you as well. But let's say, for example, you have a portfolio that is made up of a variety of different mutual funds, and temporarily, you look at your lineup of mutual funds, let's say 1, 2, 3, and important note here is that this needs to be in what's called your non-qualified or individual joint account outside of your IRAs, okay? Because that's where you have taxable income that can be impacted now. It's not shielded and passed on to the future. So we have, these mutual funds, and collectively, let's say they are temporarily, depending upon the size of the portfolio, incurring $500,000 in losses. And so we've had new prospects that came to us during COVID, and we looked at their portfolio, and they were showing these types of losses. But we wanted to make sure that we liked the funds, or we didn't like the funds in their cases, so we sold off and bought something else. But if we do like the funds, then we need to take a look at how to replace it with something that's similar but not exactly the same, that at least preserves the asset allocation or what we want to do. But if we sold that temporarily, you will incur $500,000 in losses. And if you go over on the other side, so let's say you had an ETF with S&P 500, but we go out and find ourselves a mutual fund that's substantially different, but really invested in S&P 500, eventually, giving you about the same, or maybe a DFA fund that has a different concentration and has a better fund, but at least accomplishes that allocation for you. Now you captured this, and as you invested that same money back in, and when it comes back up, you at least captured this $500,000 in losses for that period of time. And you can then offset those losses. Of course, you only can offset this against long-term capital gains or $3,000 per year of losses in your ordinary income tax return. But at least you're able to capture that loss and not lose the efficiency of tax loss harvesting. We generally find that during normal times the volumes are not that large in terms of the amounts. During COVID, you take a look at your portfolio, and we're able to just sort of see that and are able to better position your portfolio. At the same time, take a tax loss harvesting that will provide you with a scenario that you are able to take advantage of the tax loss and preserve your capital as you move forward. What I would do is I would ask Gabe to provide our link to you. So contact us if you would like a second opinion on your portfolio for us to see whether or not you have a portfolio that has this particular opportunity. We'll be able to provide that to you. You can go back and execute it yourself, or you can go back and get the help with whoever you're working with to say, have you taken a look at tax loss harvesting within our portfolio?
I have a question, Salim. Is this like specifically for COVID time, that opportunity, or is it?
No, it's available at all times. During COVID, the extent of losses are large, right? So it presents with extraordinary opportunity, and you take a look at what are the assets that are good assets that you would like to maintain. But if you can find a corollary asset on the other side that can capture that large loss, it's the magnitude of loss that's provided by COVID, particularly for a particular portfolio. Tax loss harvesting happens all the time. The question is, how do you take advantage of it and when to take advantage of it? And COVID times and the volatility right now, even in the market, is providing that opportunity. Great question. All right. So I will give that control back. And any other questions, honey, on that? So it's a simple strategy, but what does it mean to a particular family will depend upon the family's makeup. And we should be able to take a look at that and say, here is the extent of what that tax loss harvesting looks like for you.
And I do have a follow-up question on Safura's question. Is like, so what do you think the impact or what impact the elections may have on?
Yeah, so two things, right? We have the volatility in the market is tremendous right now. So one of the first impact in terms of just investing is to figure out what is going to be happening within the election, which side wins, which side doesn't win. And the challenge is you can never be in the business of prediction. I think we found out many times, not just in 2016, that's a fool's errand, right? And so the question is, how do you prepare yourself in your portfolio to address that? So besides tax law harvesting, there's another strategy that we actually put a stop loss on your portfolio, if you would. We create strategies wherein we say, okay, here's how we're going to maintain the gains of our portfolio, so we can create specific strategies for our clients in order to be able to protect that allocation. Then to answer specifically your question of what happens within the context of taxes as relates to who gets elected. My sense is that there is going to be at least a preservation of the tax cuts if the Republicans win, at least one of the three, or particularly if they win either the White House or the Senate, or keep the Senate, right? If they keep the White House or keep the Senate. Then I think there might be continuation of the tax policy. Although with the massive deficits that we have, I think they will try to find end runs around the tax law themselves in order to be able to create the tax base that they need to fund the government, to fund everything else. And so we might see some of these ancillary items going away that might be of benefit to particularly small businesses, practices, as we see. That is one outcome that I think is going to happen regardless of which party wins.
So what timeline, I'm sorry, what timeline do you think is recommended to actually take the steps to, go to and find your legal and financial professionals and have them look over your portfolio?
So my advice to them is look at it before November, because you want to make sure, as I mentioned before, the individual taxes and a lot of practices are also passed through, right? So if you have an S corporation or an LLC, professional PA, then you are, all of those taxes are passed to you individually, unless you picked C corporation as your tax vehicle. Those have a short run, and if it doesn't last you until 2025, and if there is and there's a good chance right now, at least from what the numbers are indicating, that Democrats may take the House, may take White House, then that may be a shorter 1 to 2 year run, and you only have that long to take advantage of it. So I would say do it before December for sure, particularly the estate side of it, to where I don't think that $22 million in estate is going to survive as an exemption. That's going to be a hard sell. Yeah, great question. Okay. Shall we talk about property?
Absolutely, yeah.
So a lot of physicians, right, and have properties, and a lot of them are invested in individual real estate, their real estate within their practice, or just other investment real estate as we go along.
Can I interrupt you? Sorry, I'm so sorry. But I want to go back a little bit. Did you say that the tax cut or that exemption, the 22 million, will not survive? I mean, is it already in law till 2025, or it could be changed? I suppose it could be changed, right?
I'm sorry, I didn't introduce. This is my husband, Dr. Sana Khan, and he's supposed to represent the physicians. And he asked the questions on behalf of the physicians usually, but I guess he logged on later. Sorry.
No, I'm just asking this one out of fear.
So Dr. Khan, nice to virtually meet you. The estate side of the equation right now is on the permanent side. So that part is set. The issue is that if Democrats take the House, for example, or they take all three as they did back in 2008, it's going to be very hard for that provision to survive, because it is unusually high for an average family's perspective. And my sense is that we might go down to the 11 million total. That's the consensus in the professional world right now. And so, I don't think that will happen immediately. There might be some time frame, maybe a year or so before, but typically, if there is all three divisions of the government flip, there's a very high likelihood that will not survive.
This is what our CPA tax lawyers also they're anticipating. By 2025, it'll be 6 million per individual, 12 million married couple. So,
correct, and that will taper down at that point. I mean, we are running more than $1 trillion in deficit and we were running $1 trillion deficit in Goodyear last year, right? Or close to that. And we're running, a lot more than that right now. It's going to be a hard sell for any government to continue to keep the taxes at the rates that they are at. And I think that we're going to probably see pressure on both governments to be able to do that. And estate taxes are low-hanging fruits typically for them to come after. Okay, great question. All right, so when it comes to property then, the one thing that you should think about in those states that there are high real estate taxes, particularly based on property values, although there has been remarkably lower, if you would, bankruptcies and foreclosures right now, but there seems to be a pressure on real estate prices, particularly in segments of the market. So if it's a retail strip center, single occupancy tenant like a physician's practices, you want to make sure that you negotiate those real estate taxes and valuation. Make sure that you hire a professional to help you, negotiate those. Try not to do it yourself, although if you feel like you're capable, do it. But I've seen tremendous amount of value that's brought by these professional institutions that actually do that. And it's hard to find good ones, but if you do find good ones, and we have recommendations for several, you want to make sure that you take advantage of the lower tax valuation and you fight for it, because the typical government and municipality right now, counties and parishes, are fighting to keep their tax rolls as high as they can, while there's tremendous amount of downward pressure on rents and on property valuation, which is just being kept, in my mind, temporarily afloat by the $3 trillion that the government has funded throughout the system. We are starting to see that wane off the system right now, so we don't know what that will be by the end of the year. But still, there is a lot of value in making sure that you negotiate your taxes. There's also, go ahead.
Salim, I'm sorry to cut you off. I received actually a text on my phone, basically, in being in Texas and us, majority of our attendees are in California. Is this something that you can also assist, where you can negotiate or maybe recommend, a firm that can help in negotiating the real estate tax?
So we, again, as I said, we do not actually negotiate taxes with the entities. But we do bring in professionals. And if you have someone that's interested in that, please share, and I will recommend or share our recommendations with them, definitely. Great question. So temporary devaluation of properties, right? So the other thing, particularly in what's called special purpose facilities, such as single purpose medical practices, which has taken a tremendous amount of hit in terms of valuation, in my mind, and downward pressure on rents. And those special purpose properties, such as retail centers, hospitality. If you own a hotel, my goodness, I mean, that particular industry has just been through a ringer, if you would, right? This is a time to take a look at, what is the valuation of your property prior to COVID and now? And we're finding tremendous differences between those valuations. And in many cases, there might be temporary valuation depressions based on what the COVID is doing to the business, if you would. And so what we're suggesting, as we talked about earlier with Dr. Khan, is if you are in that particular estate bracket where you are coming up to that higher level, let's have a conversation. Have a conversation with Sephora, with Hani, with your tax advisor, particularly, to say, okay, can we do this to where we can capture this lower valuation, put it into a trust, if you would, and lock that temporary valuation in, thereby taking advantage of the temporary lower valuation of the property itself. You're saving money on how much is taken off of your exemption, and you're able to pass that growth back up that happens to your next generation estate tax-free. That is a remarkable benefit for families to consider, particularly when it comes to those special purpose properties. And this may be available in general purpose properties as well, multifamilies or otherwise. But that's something that you'll need to make a decision on individually, and that'll be in a case by case basis. Okay. Any thoughts there, Hani, Sephora?
No, this is just so true. I mean, what you're talking, I mean, you know, again, COVID presents lots of opportunities, and this is something really, I mean, for lots of the physicians out there, it should be focused on, and it's how do you can basically negotiate the real estate taxes, but mainly is capturing that the evaluation and just, you know, put it where basically you could preserve it and pass it on to the next generation, and just again benefit from that gain in the future, because you know this is a temporary situation, but why not take advantage of this now?
Absolutely, and I think this, you know, brings the into focus the notion, right, that it's important for you to create a long-term plan, but then also have the ability to maneuver that for special situations like this one, right? And what that brings for you. So be tactical when needed. Be you know, be strategic on a long-term basis, but be ready to be tactical. Similar thought process, particularly for mature practices, right, where they have the ability to transfer the value of their practices to the next generation sometimes, or to, you know, we want to make sure that you are able to capture the temporary devaluation of your practices, but putting that in a similar trust or estate, or transfer that, you know, through contract. And that's something else that needs to be considered very carefully. There are pros and cons to this. Sephora?
No, I was just listening to like business succession of the practices, right?
Yeah, if they were thinking about it for years, from a valuation standpoint, this might be the right time to do it, to where they know that there is a temporary devaluation within the marketplace, if you would, and you know, we can look at a variety of different ways to make sure that that is captured, transferred, and is able to benefit the next generation, or you know, down the line to whoever wants to take over that particular practice, or any other business that for that matter. And so this is important for you to have that conversation with your, you know, trust and estate professionals, with your tax professionals, in order to make sure that you are, and these numbers can be very large depending upon how and what the value of your practice is. So careful consideration must be made, but I believe there is a tremendous opportunity through the end of the year for that as well. There's one more item. It may sound minor, but it's actually pretty interesting that, you know, that we take a look at, and a few $100,000 here and a few $100,000 there, then you're talking real money. And so there is another provision, which is COVID-related provisions there. For those physician practices that are looking at, you know, almost everybody knows PPP, almost everybody knows the EIDL, the Emergency Loan Program, but there was a law before within the CARES Act and before CARES Act, right before CARES Act, that provided a lot of provisions for employers to continue their practices and their businesses, and paying employees, particularly smaller businesses, was a focus of these laws. We want to make sure that if you still have an impact from COVID, you take advantage of those, the credits that are given to you for employing people. If they're not able to come into work, and you want to continue to retain that, you know, precious PA or nurse or whoever you had, that credit continues even today. So talk to your payroll company, talk to your tax advisor. We've seen, depending upon the size of the practice, tens of thousands of dollars per, you know, per week or per month's worth of payroll, that particular benefit, the tax credit benefit, is provided to them, while it helps them retain those particular employees. And the other, sorry, go ahead.
There are other type of programs other than, as you mentioned, other than the PPP or any EIDL, right? These are extra.
Correct. These are in addition to, so these are direct tax credit for employing and continue to employ your people who are impacted by COVID. So for example, if you have a PA who cannot or who is impacted by COVID, right? And you don't want to let them go, but you want to make sure you're continuing to pay them, you can and claim a tax credit for that. Okay. Again, there are pros and cons, and there are provisions that you need to be careful about, but that's where you talk to your tax advisor and you talk to your payroll company, and they'll help you set that up. But in this way, we've been able to help a lot of practices retain key employees and other employees that they don't want to let go. A lot of times we're finding that they have childcare issues that they can't come into work for a couple of weeks, right? So how do you continue to pay them while you're trying to maintain your own practice? And in this way, they're helped and you're helped with that as well. And not to mention, I mean, we had one client who was not even aware of this, and when we provided that, the goodwill that was garnered, right, from their employees, from their staff members, was tremendous value. Right? So just being aware of this and taking advantage of it, there was no money out of, I mean, there was money out of their pocket, but 1/4 of what it would have been otherwise, right? But they were able to, for a very small amount, retain that employee, but also look like superheroes because they were able to do that through this. Okay? So there's that. The other much not known provision of the CARES Act, and we tell people not to do too much with it because obviously you're rating your future kitty with it, but the CARES Act actually allowed each individual up to $100,000 in withdrawals from their 401k, from their IRAs, if need be, without early withdrawal penalty. Okay. The other thing that it does do is that it provides the option to the person that's withdrawing it, the ability to tax that withdrawal over a 3-year period. So for example, let's say you have $1 million 401k or $1 million IRA, and you need that money to sustain your practice or to do something else with it, and you're impacted by COVID, then you can take that $100,000 out, but pay taxes on it as if you took it out this year, next year, and the year after. So 33,000, 33,000, 33,000, right? Here's the kicker, and the coolest thing about it. You can actually pay it back as if nothing happened, right?
Is there any restriction on that, or are you just?
You can pay the whole thing off, and put it back into the account as if nothing happened, right? And you won't. I mean, you'll have to do a clawback of your taxes again. Talk to your tax advisor, but you have the ability to pay back into the account, which is what we suggest. So if that is your only, and again, as I mentioned earlier on, have enough capital and cash available to run your business, but if you are, somewhere where you really need to do that, then there is some relief available for you. So for a couple, typically 100,000 each, that's $200,000 available for you to withdraw and manage your taxes along with that. So there are nuanced things like that in the law as well. Okay.
I mean, it's a lot easier to save $5,000 in taxes than generating $5,000 in income, and especially during these times. So this is such an important topic and very great strategies that we should definitely, take advantage of.
Right, absolutely. That would actually summarize some of the high-level COVID-related tax opportunities. There might be others that would be individual to families, to physicians themselves. Gabe was kind enough to, and I'll ask him to post, our link again. We have an understanding with Hani, with Sephora, that for their clients and for their participants in these valuable programs, that we would provide our second opinion services, a 30-minute consultation, no strings attached. The goal of that is to take a look at whether or not you have the ability to do something with your taxes. If so, we tell you to go back and see if you can do something on your own. If you have a professional that you're working with, we sort of give you pointers on what things to talk about. And if you feel like you want our firm to take a look at that, we're happy to look and discuss that with you. What we do find, Hani Sephora, is a lot of times, particularly with our physician clients, when they come first time on board with us, we actually do what we call a tax return x-ray with them. We actually take their 2019 or 2018, whatever the latest tax return that they have, and we run an x-ray for them, literally breaking that entire tax return down for them. And we've been told that this is the first time anybody's ever done that for them. And this is the first time that they actually understand like what is, the composition of their tax return, right? Which major areas to hit. Because most of the times, most tax professionals basically on April 14th send you something to sign and say, make a check for this amount, and that's it, right? And you're done. And you never literally see your tax return. We are a planning firm first, a tax compliance firm second. So we look at it from a planning perspective and we run an x-ray on our clients. So if we find opportunities that are COVID-related tax opportunities, they will come up on in that.
That's such a great service. I mean, and I love the name too, but it's such a valuable service.
Absolutely.
Is this been recorded, Henny?
Yes. No, we recorded.
Yeah, I think it's interesting to post that onto our doctors group as well, because there was a lot here that I think would be very, very valuable. Just sometimes it's difficult to get, doctors to come on in the weekdays. So weekends probably going to be better. Anyway, so if it's recorded, if you could send me the link, that'd be great. I'll pass it on to a whole bunch of docs too.
Absolutely.
And Sana, do you have any other questions?
No, it's great. I'm really like that's. I didn't realize there's this much available. There's so much has changed and everything's moved so fast. So Salim, do you have you broken it down in some maybe little like list that we could look at to say, okay, sort of the COVID-based opportunities and just a kind of a visual breakdown?
I have not done that, but that is possible. I mean, we generally try to keep things a little bit more general in nature, because we found in the past that if you become too specific, then there might be a tendency to go do it yourself without consulting the right professionals, your own professionals. And so we don't want to come across as recommending something.
Right.
What we do say is that the best way to do this is to do your tax x-ray. So if we take a look at 2019 returns, if you have those, or even numbers, then we can take a look at a high level information and then compare that to where you are today. So we would do a planning session to where we would look at what is your income looking like, what does your practice look like, where are your comparatively, where would you stand? These things come out really quickly, because the portfolio tax loss harvesting requires us to take a look at your portfolio, right? Not just your tax return. And then your real estate assets will pop up in your tax filings. We'll see those in your schedules that you filed.
Where's your office at?
We're in Houston. I am actually in the suburb of Houston called Sugar Land.
Where?
Sugar Land, Texas.
Sure, of course. Yeah, no, I'm pretty familiar with Houston.
Yes.
I don't know if you've heard of Altus Healthcare.
Yes.
With Tasir Badar and.
I'm familiar with this here. Yes.
Yeah.
Great group. Yeah.
Yeah. So I was actually a founding partner.
Very nice. Okay, good to know. Small world.
2004. Yeah. So yeah, I know those guys quite well. Actually, I'll probably be coming to Houston, I think, in November. That's when I'm supposed to be there next. So.
Yeah, I mean, we have a very robust community here, and that's the other thing, right? As I mentioned at the top of the conversation, it's very hard sometimes to be part of the community and express yourselves and what your desires are, continuity wise, asset preservation and generational wealth preservation standpoint, right? We actually create family boards right? To have conversation across, because sometimes parents feel like they cannot communicate with their children sort of what have they done, and they expect same values from them, which is not the case, right? And so it's important to create that dialogue, and certainly there in California and here in Texas, in Dallas, Houston, Austin, San Antonio, we have large community bases and very underserved in terms of how
Right.
Well, I mean, it's shocking to me how many people actually don't have a will and trust in place.
Yeah, I know that's, at Cornerstone Law Services, that's what me and Hani are really trying to do. And I know that you mentioned your background, and I just wanted to see if you would mind giving a recap of your background for the people that may have joined a little later and missed it.
Yeah, so to really just give you a summary, the reason why I wake up every day, the reason why I do this, and our singular goal at Benzer Capital is to preserve our client families' wealth for generations to come. It comes from my own personal story. As I mentioned, my grandfather was in one of the wealthiest families in South India. And we were in the business of the largest manufacturer of Bunsen burners under the brands of Coronet and Crown in South India, based in Madras, now called Chennai. And my dad was 20, 21, still in college, and they employed 600, 700 people. And my grandfather actually went to Bombay for a business meeting, and he never left the meeting. He actually passed away on the spot at the restaurant. And my dad came into this large, complex business that, of course, had no, estate planning put in place at a very young age. Within 5 years, when he landed himself in Bombay, he had 300 rupees, equivalent to a few dollars, if you would. And as I told Sephora, he did have three things going for him. He had education, he had ethic of hard work, and he had faith. And he both deployed them and shared them with us, and we're inheritant of those values, right? And we emigrated to the US and we pulled ourselves together. And I said to myself when I joined this business, it is my mission to make sure that no family goes through that experience again. And so I'm reminded of that every day as I go about. And I have been very fortunate. There are examples in my practice where, had I not pressed those families to do what they do, they would tell you themselves, but you could see the consequences of not doing those elements of planning that have saved them tremendously in terms of both personal wealth, but also preserving what they have worked so hard on.
So, well, thank you very much, Mr. Nathani. It was very relevant and helpful information. And the tips, especially with these, uncertain times during COVID and just everyone wondering what's going to happen with the economy. And if anyone has any other questions, you can email us at info@cornerstonelawservices.com and we'll respond as soon as possible. And you can check out our website, cornerstonelawservices.com. And as usual, I'd just like to emphasize that the purpose of these webinars are for educational purposes and not intended to be legal advice. And please contact a legal professional to develop a proper plan that's right for your personal situation. And thank you everyone for joining. Really appreciate it.
Thank you, Hani, for Dr. Khan. It's been a pleasure.
Thank you.